Podcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to the May 2021 edition of our Yankee Model Investment Club meeting. My name is Brent. I'm the president, and I'll walk you through a couple of introductory slides. If you've been with us in the past, you'll know it's pretty standard information about the background of the club, but anyone new, feel free to join in and listen to where we've been and the structure of our meetings. So the Yankee Model Investment Club is a better investing, or BI, model club. We're a fully functional club with real money, but open to observation by the public. We were formed back in 2008, currently have 6 members spread across 4 states, and we went solely online, meeting in 2011. We meet monthly on the second Saturday at 11 a.m. Eastern. We're currently looking for new members. No investment experience is required. New members are mentored by an existing member, and really no limitation on where you live except where your state tax laws require the club to file a return. All partners of our investment club must be members of BI, expected to actively participate in our club activities, so this isn't a passive investment vehicle, and doing so by making stock presentations using a stock selection guide in rotation with our other members, as well as participating in club housekeeping and other roles for the club structure. For our operations, we follow BI principles. We show respect to fellow members. I have to remember that we're all still learning. None of us are experts in this. We perform an annual audit of finances that we just wrapped up in a few months ago. We file tax returns and follow our partnership agreement. And if there's any follow-up questions, or if you're interested in joining, or any topics come up that you want to discuss further, feel free to contact our secretary, Sriram, at the address shown on the screen, and I'll put his contact information back up at the close of the meeting. The structure of the meeting is pretty standard. We have an agenda that we follow. It's been posted in the handout section of the GoToWebinar control panel on the side of your screen. All visitors will be muted throughout the meeting, but can ask questions by typing them into the GoToMeeting control panel, and Joe, our moderator, will do his best to answer those questions. And if they're of a general enough topic that would be helpful to the greater audience, he'll chime in with the question and we can discuss it. We'll also have a Q&A session at the end of the meeting after our general business is complete. And then just a note on the invitation that you received to the meeting. We're certainly glad to have all of you, but just a heads up that if you received an invitation that was forwarded from a friend, we likely don't have your contact information, and you don't get the benefits of being automatically reminded for future meetings. So encourage you that if you were forwarded an invitation to this and you like what you are seeing in the meeting and want to join us in future sessions, we encourage you to go to the Better Investing site and register for future meetings. And that just gets you a reminder sent I think it's a week, a day, and an hour before the actual meeting time with the login information. And then finally, our boilerplate disclaimer that we're going to be discussing securities and financial ideas in this meeting. We are not financial planners. We're not financial analysts by any means. None of the discussion taking place today should be taken as suggestions or recommendations for purchase. So do your own due diligence, do your own research before you invest any money in any security. And with that, we will jump over to our standard agenda, which we usually start with a short educational segment each month. And this month, I believe Steve's going to be presenting on profit margin. So Steve, I'll give presenter rights to you.
Sounds good, Brent. Thanks. Can you all see my screen now?
Yep.
Okay.
Yep.
Okay, so this is a very mini presentation on profit margin, originally presented shockingly in 09, and now here we are in 21. So what is this talking about? The definition of profit margin. What is net profit margin? Why is it important? And how to try to find some profit margin in companies so it makes sense. Yeah, that's pretty good. Okay, so what is the definition of profit margin? So it's net profit margin equals net profit after taxes divided by revenue times 100%. And so really what does the equation mean? The profit margin tells you how much profit a company makes for every dollar it generates in revenue or sales. This is also known as return on sales. This value is the net income after taxes for the trailing 12 months divided by the total revenue for the same period, and it, you multiply by 100 and you get a percentage. So for example, let's say a company is selling widgets for $5 each. The actual cost to produce the widget is $3. The company's profit margin would then be $2 per widget, or 40%. So kind of why is this number drilled in on? Why is it important? So the relationship between a company's earnings per share and its profit margin is a very significant one, as a company's profit margin typically drives its earnings per share, and that's why it's important for you as an investor to look beyond the company's earnings per share and drill down into its profit margin. A low profit margin indicates a low margin of safety. So higher risk that a decline in sales will erase profits and result in a net loss. Terms, so back in the day, and the day being 09, Morningstar used net margin and Yahoo used profit margin. So it's the same thing, but people were calling it different names. And now Morningstar has come around, and you'll see I have a slide of the current analysis, and they call it operating margin. So how can I apply this? And I think this is kind of important here. So investors need to be aware of both overly low and overly high net margins when comparing companies in the same industry, and that's the key here. It's companies within the same industry. That's the key. So you can't compare Visa to Google to Amazon and looking at net margin and expect to get a real answer. So you need to look at retail and compare retail to retail, and luckily you'll see that we have such a comparison in the stocks that we currently have, and I'll show that to you in a minute. But and we should not be comparing margins across industries, right? Okay. This is the ancient, and I happen to. These are 3 different industries, which doesn't make a lot of blah blah. And then this is something ancient that I didn't check into. Ancient. Okay. So here's what I wanted to talk, and hopefully you can see this. So I open it up with Alphabet, where really I should have kind of put that at the bottom, but what I want to concentrate on now is we have 3 different companies that really their main thing is credit cards. So, and it's a wonderful thing. And so we're going to start at Visa. And if we look at the operating margin, for the past 5 years, their operating margin has been 65%. Visa is the king. They are the king. And it's just, you can look at it by the years, and it's just phenomenal. So then FleetCor, they're in the kind of the same market, I would say. And so look at this, 40% margin, phenomenal, right? And past 5 years, call it 42% margin, but Visa's still king. And then I thought that it was very interesting to see intelligent systems. So, and what's hysterical is, I think it was in 18 that they switched to the fintech, to the credit cards, and then look at all of a sudden the margins straighten out. And even in 2020, a kind of a crummy year, they still have phenomenal margins compared to what they were doing before, where they actually had negative operating. You know, it was just very, very poor. And then all of a sudden they straightened out, and now they're on the path. So I thought that was kind of illuminating. I hadn't really looked at that when I had done the analysis. And I think it's really good to see the three of them. They're very similar, and you can see the king and then the next two, and their stock price show it exactly. So if one of these, if FleetCor or Intelligent Systems were to take off and all of a sudden their operating margin get huge, the stock's going to appreciate quite a bit. But this is what they're doing. This is what they're average. And so to put kind of the credit card kind of a thing in perspective, I took some other ones from our portfolio. So Alphabet, which has a phenomenal operating margin, and the last 5 years is about 24%. And to give it some more context, this is one of the companies that I'm monitoring is DR Horton, and their operating margin for the last 5 years has been 12.23%. And then if you look at Middleby, that's another one that I used to follow. The last 5 years was about 18%. So I really think that this is a validation that we have a tertiary offering in credit cards. Credit cards make money, a lot of it. And it shows, you can see why here. Their operating margin is huge. And, you know, I consider Alphabet to be a fortress stock, a fortress balance sheet. And look at these operating margins, just phenomenal here with the credit cards. So that's kind of my little mini tiny presentation. Brent, thank you very much.
Okay, thanks, Steve. Any questions or comments from the team?
Just one small comment on the stock selection guide. They have pre-tax profit margin. I get the thinking being, I suppose, that you know, companies cannot control the taxes that they pay. So the SSG considers pre-tax margin a good indicator.
Thank
Okay,
you, Ira.
good point. Thanks. Okay, excellent. Thanks, Steve. We'll move on then to the next item in the agenda. I'll give presenter rights to Sriram. Can you present the minutes from last meeting?
I have put the minutes into the handouts.
Okay, thanks, Joe.
Can you all see my screen?
Yes.
Excellent, thank you. We had a pretty good meeting last month. Here are the minutes from the last month's meeting. We had 52 visitors out of 317 registered. Brent started the meeting on time, and we had pretty productive meeting with the initial education segment on Altman Z-score. I think that was well received. And then I gave the minutes from the last meeting again. It's on the public folder and also on the internal minutes folders. Jack, you presented the treasurer's report. Again, this is the summary of the report from what he presented. This is the diversification chart based out of what I found. Again, we do have a large portion of our stocks in the medium and large portfolio, large capital assets. And then Liz presented a SSG for superior group of companies. We had a good discussion and we decided unanimously to purchase the stock. And then we went through each individual presentations of our stocks. And I know we did have one particular, I forgot, I think the one we sold, we put them back onto the watch list. And then we decided to sell Miller Industries. By the way, it did drop a little bit since we sold last month. And then we decided to buy SGC as well as add some more to FG shares. And then there are some questions and then answers that Joe presented back to them. Again, this is a list of the folks at the bottom. Any questions or any comments or any changes to the report?
Did we say we were putting Miller back on the watch list? I'll update the agenda for next time if it is.
I'm not sure. Well, I no, not Miller. I think the one we sold before. I think that was GVRT.
Gentex.
Oh, Gentex. Yeah. Okay.
Gentex.
That's on the watch list. Got
Yes,
it. Okay.
yes.
Thanks.
It's added to the watch list. Any questions or any comments?
No questions from the audience.
Excellent. Thank you. Brent, that's
Okay.
the end of
Great.
my
Thanks,
report.
Sriram. Okay. We'll move on then to treasurer's report.
Alrighty, let's get my screen. Okay. You see my screen?
Yep.
Okay. So this is our present status. We're up to about $226,000 in market value. You can see we bought, or is it Superior Group of Companies? It's now, we were aiming for 3%, and that's what we got, 3%. And then where's the bank? FSFG we increased it to about 4.6% of our holdings. So managed to get more or less where we were aiming for. Okay. Let's look at the member status. All the members have paid their monthly dues. Let's see. I want to show something. Oh yeah, this isn't okay. Sorry, I was confused about where I was. Transaction history, we picked up a dividend of a penny from Fidelity. So we sold Miller. Here's that, sold Miller giving us about $6,000 or so. So I bought First Savings Financial, but for some reason, my first price to buy it at, I only got 5 out of 60 shares that I wanted. So I upped the price a little bit. So we have 2 prices for Miller. I'm sorry, for FSFG, one at $68 and a penny, and one at $68.50. So, and then we purchased 260 shares of Superior Group. I think we got a couple of dividends, just $1. We got dividends for Dollar General. Okay, and then everybody's up to date. Okay. Performance benchmark. Looking for the life of the club, comparing to the Vanguard 500 index. We're doing a slightly better, 0.5% better or so over the life of the club. If I change it to last year or so, we're doing about 4% better over the last year. There was, as you may recall, a little dip last year in March or so, I mean February. So if we skip by that and look at 12 months ago or so, we get, we're doing 13% better than Vanguard 500. So good for us. Okay, investment performance. Our big winner is Middleby, going up an annualized rate of 75%. So this is from this is over about a year, so this is close to believable. It's gone up an awful lot recently, so that's nice. It's now our second largest holding, I believe, Middleby is. Tractor Supply is doing awfully nice at almost 50%. Dollar General and Visa is doing good. A lot of these guys down here are doing very nicely as well. Okay, but it doesn't bother to show things that are over such a short period of time, so we'll see them I think we see them at about 6 months or so. Okay. Congratulations to Sriram and Liz. They're doing much better than the rest of us. Okay. It pays to know when to buy, I suppose. Okay. I did want to point out, if you look at the unrealized gains, for the first time that I can recall, we have gains in every stock that we own, which is unusual for us. Usually when we first buy a stock, it goes down, but not this month. So hooray for us again. Okay, that's the treasurer's report.
Yeah, that happens once in a blue moon. So
yeah,
let's celebrate while it happens, because it's
Savor
not
it.
very often. Yeah.
Yes. On the flip side, Miller has actually gone down after we sold it, so that's also
Hooray.
Okay.
Brent, I have a question.
Yeah, please.
So do we have anything in the policy or the bylaws or whatever you want to call it about what the goal for the total percentage of the portfolio each position is to be? Is there a guideline that's somewhere that's in writing? Because there's getting to be a lot of stocks now. So before it was like you could just look at it and it was manageable. Now I want to think about it. So I just want to know if there's something in writing or what.
I think there is. There's a minimum of like 3%, which is why we tried to get our low one up to 3%, up above 3%.
If you go to Bivio, you could check. We have all our policy statements there.
Okay.
Yeah, I was gonna say I agree. We'll check it to confirm. I didn't think we had anything written on the individual securities. I know we have something written that each in any individual member can't have over like 33%.
Yeah, we do have that. Yep.
But I'm curious also to see if we state anything about the individual securities.
I think we do. Why don't you call it up, Jack? Could you do that?
Yeah.
It won't take long. Just go to files and the policy statement.
Yeah.
Steve, was your concern just because it's looking like a super long list of companies now?
No, honestly, I was able to do the math in my head before, and now it's like, what percentage should this be? And I'm looking at the percentages, and I'm like, well, how should this really be broken down? The theory wise, of course, we want to let our winners run, but
The policy statement have 0.
Yeah, so it's. I guess my concern was
investment policy statement. This one.
Yeah.
Yes.
Okay. What we want to invest in, what we don't want to invest in. Okay, what the distribution should be. There's the minimum of 3%, no holding to exceed 25%.
Okay, so we have a minimum and max as long as it's
Yeah.
above 3 and below 25. Okay, I got it.
Yeah.
Thanks.
Okay.
There's one additional one in there. It says the number of stocks cannot exceed 4 stocks per member.
Yeah, that's a lot.
Number 6.
Yep. Okay.
Better investing in general suggests somewhere in the vicinity of 10 or 12 at the bottom and 16 to 18 at the top. Rough numbers.
Yep. Okay.
Okay. If no other questions on the treasurer's report, thank you, Jack. Why don't we jump to the stock to study, and it's back to Sriram.
I hope everybody can see my screen.
Yep.
As a stock to study, I took LRN, which is the Stride Inc. It's a educational company. Basically, they actually, I'm trying to show you a business description. It's an online educational company. As you can see, they are more and more getting into traditional on-campus schooling, and their goal is to maximize the advantage of what we have been going through for the last year and expand, and they want to be able to make deals with individuals, public schools, as well as Even there, I believe they're also going into some of the college level education, but pre-college level at the high school level. So I think that's the company that we are looking at. Can on the surface, it's not very exciting company. The timeliness, safety, technical, but there is a potential for this to grow, and hopefully we can take advantage of buying it at this point if we find it to be in the range that we want to buy. What I did is before I did this, I actually looked at different alternatives, and there is a similar company that Liz suggested. It's called EDUC. I think it's called Education Incorporated or something like that, which I thought is a educational development corporation. It's a similar company, but I also looked at several other ones, but I decided to look at this. Actually, this was suggested by Ira. Let me see. I will show you the SSG. Maybe I should. Okay. Let's see if I can bring up the study. Bear with me for 1 second. No. As you can see, in the latest quarter, they had a sales of about close to 400 million with an EPS of about 0.57, which is considerably above compared to a year ago. If you look at the pre-tax profits on management on section 2, you can see there's a there's a drop from last couple of years, but still it's within the close to the average. And then this is the PE history and how we arrived at the risk versus reward. I came up with a high forecast value of about $74.50. And I used I believe last year's low of 24. And with that, this is in the buy zone. Let me pull up I hope everybody can see our summary template. Again, fundamentals are decent. Again, not very exciting, but I think Altmancy is within the reasonable estimates that we want it to be. So this is the 5-year projected return is about 84%. That comes to about 21% on the projected average return. So based on this, I certainly would make a recommendation to buy. Any questions or any discussions on this?
The other ideas that you got either from Liz or others, you looked at those and then still went with this one.
Yes.
What were the advantages of LRN that were better than those other ideas?
Mainly the future potential. And then I believe this is a growth company. This is the whole market of education. I shouldn't say market, but the business of education will be going towards this online learning, and these guys are leaders in that.
Shriram, how much did the pandemic affect them, and as the K through 12 goes back to in-person learning, and actually colleges do too, how much is that going to reduce the demand for these guys' services?
Actually,
to get an idea of that.
yes, from what I understand, doing my research, actually that may be benefiting these guys in the sense that in spite of schools opening, there is also a good portion of the population, they really want to take advantage of these online resources.
Yeah.
In several states, they are looking at using this model to mix with the actual classroom learning. So the way in which these guys are training, that would be an advantageous, like it's not exactly going to replace K to 12 classroom learning, but it'll enhance and it'll supplement and complement the K to 12 learning. So in my personal opinion, it certainly is going to benefit them rather than have a negative effect.
We have a question from the audience. Any reasons for the choppy earnings per share history?
Yes, I mean, again, their model, let's see, their model is based on, something that is only being developed in the recent years. And I believe they're also expanding internationally.
But there's not much competition out there for them.
Yeah.
Are they selling their product, or whatever the right phraseology would be, to the homeschoolers?
Yes.
Okay. I know
Yes, that's another market they're looking at. Yes.
Well, I'll chime in with kind of some of my comments. I must say that the visual analysis just on page 1 of the SSG really didn't do anything for me. It's up until 2020, they had a fairly flat like growth rate, and even they had a big dip in 2017, and then kind of like Joe alluded to in the visitor's question, choppy earnings per share. And it looks like, at 2020, that's when this kind of rocket growth is taking off. But I would have the same question on, is that coincidental with people staying home and doing online education that may not be sustainable as things hopefully get back to a more sense of normalcy? It strikes me as kind of like a turnaround or recovery play on this, that the quarterly changes look great. I know that I think the value line projected, or S&P projected growth rates is like 20%, or analysts projections are 20% growth, which is great. I just don't know what that's based on, and is that sustainable for 5 years, or is that just like over the next couple quarters? So when I was doing the analysis, I put it at the historical growth rate of 5%. And then was also shocked by the PE ratios of, even discounting 2017, I mean, highs of 50, PEs of high 50s to low 25s. So I judged those down also to be more in line with at least the 52-week highs and lows. And unfortunately got it in a so high priced compared to those ranges that is in the sell range for me. So it looks like a promising company. I don't know that I would hang my hat on 4 quarters of historical growth. I'd want to see maybe another year of more or less sustainable growth, and that management is converting that into profit correctly.
Sure.
We have another comment from our visitors. As an educator, I would keep a real eye on this. There is no going back to normal. Her indication would be that maybe this is the thing that's coming ahead.
Okay, that's good insight. It's a little bit scary, I guess, but we'll have to deal with it. Any other comments from the rest of the team members?
Yeah, I suggested that Sharam look at this because I noticed it when Value Line added it to their list. So it piqued my interest. Then I saw that in my assessment, I think the pandemic has pulled some earnings forward, and it won't be as robust going forward. However, Value Line is showing the low price in 3 to 5 years is $50. The analysts are saying 20% growth. So I thought it was an interesting thing to study. I think it has a lot of potential. It is a little riskier than some. So also we should consider how many stocks we want to own and all of that as well, of course.
We have another comment from the audience. What other significant competitors are there for LRN, and they also experience this type of growth during the pandemic?
There's a company that just went public recently called Coursera. And I'm not quite sure if they're a competitor, but they have online classes. You could get a college degree using their online system. So that's one that I know about.
Yeah.
Did its growth look similar?
See, in the K to 12 market, I don't think there is much of a similar company. At least I did not come across.
Okay.
Yeah, Coursera is more for college, I think.
I've taken some Coursera courses.
Yeah. Oh, I was also happy that this company has actual contracts with both public and private schools.
That's true. There's probably a fair amount of stickiness with that, right? That once they're locked into a system, I don't know how quickly they would pivot to a different one.
Yeah.
I thought it was interesting that Value Line started following them as well. I don't know how often companies are added or removed from their, I guess, portfolio of what they stock or what they cover. Liz or Jack or Steve, any comments?
I ended up with this in the buy zone, but I think I agree that I'm a little trepidatious about the relatively short time frame we have of earnings growth, short and choppy. I'm trying to figure out if they actually lost money recently. They did have actual losing quarter in 2017. So that's not very long ago. Oh, there's a 2019 third quarter loss. So that's not good. So it ends up in my buy zone, but I think this might be one we want to watch for a while to see if it continues its growth.
I had it in the buy zone as well, and I had the high price up to 69. And my thought on this was it's kind of a gamble stock that maybe we could squeeze out some profit over maybe the next year and then dump it if we need to. So I was looking at more like kind of like a gamble in a short term, which is not right in line with the better investing, but they do also say that once you've got an established portfolio, then you can take some risks. So this might be a place where we want to take some risk.
Jack and Liz, what did you use for like estimated earnings per share growth and your high and low PE? I'm curious what your numbers were to get into the buy range.
I got a high PE of 30, and let's see, high earnings per share of $2.30. Yeah, I had to sort of finagle the numbers a little bit. What the heck? Average low PE, 227.3. That doesn't make sense. I'm just looking at, I'm looking at the part 4 on under evaluating risk, and part B, forecasted low price. No, that's wrong. That thing, those numbers, forget I said those numbers. My low price is 22.3. So I'm kind of in the same ball game. So let me see here. Looking for my PE. And I also got it at a 20% sales forecast.
Okay. 20% sales, and then you did preferred procedure, I guess, to do earnings per share growth, which was maybe a little bit higher than 20%.
Yeah, I have projected 5-year sales growth is at 20, and then my annual EPS growth came out to 15.4.
Okay. And Jack, I'm assuming your numbers were similar. If you're still with us, you're on mute.
Yeah, they're in the same range. I ended up with, I think, a high price of 78 or something.
Okay.
Yeah. Yeah.
Brent, can you make me presenter?
Sure.
Can you see my screen now?
Yep.
Yes.
Okay, so and before I start this, Sriram, please don't take a drop of what I'm going to say personally. But So please don't.
Not at
So
all.
first we'll go over what I like about it. So the website's really slick, and it has this broken down. And if you have a kid that's really smart, you can send them to the George Washington University High School. Well, okay, that's cool. So that's about as much as I like on it. So that's my highlight, and I'm going to get kind of dark about it, what I don't like. So first, let's do it by the book here, and I'll show you my SSG. And so my high price on this thing's 47.7, and my lowest. And so this, for me, the current price is 28.38, and so this is in my hold range. So it's not in my buy zone at all. I'll show you the chief thing that I don't like about it. This. So right here, as Jack had alluded to, we lost money just over a year ago. Oh, so, you know, for whatever reason, they didn't have the proper contracts, or they didn't have things locked in. You know, I'm sure management is trying the best they can, but they lost 25 cents a share before the pandemic. Now, of course, the pandemic is going to drive a lot of people to this. And then here's the dark part. So I have zero tolerance for anti-vaxxers. So who's going to use this product? Anti-vaxxers, right? That don't want to send their kids to school, that just want to go to this beautiful website. Oh, I don't have to do anything to teach Johnny. He's just I'll plug him into this system, and it teaches him school. Perfect. Okay. I don't want to support that. Sorry. So, and this is going to last for about 3 years roughly. So yeah, you're going to have earnings uptick for 3 years here. And to Liz's point exactly, the only way I would want to buy this is if the second this thing starts rolling up. This is a cyclical play in my book. And from what I hear, people don't want to teach their kids at school. They want their kids to go to home, to go to school. They don't want to do it from home. So this is a royal pandemic play. It's very cyclical. They haven't managed their earnings. And oh, by the way, their Altman Z is under 3. We know that's anything under 3, it's bad, right? There's a potential of bankruptcy. Not now, because they're raging, they're going crazy. But you know, it's just it has the potential. And quite frankly, what shocked me was when I saw the value line, that they were projecting that much earnings increase next year, which is, you know, it's phenomenal. And are they going to maybe do it? Yeah. Do I want to take and then do I think the pandemic is going to kind of go for 3 years? Yep. So would this be a cyclical play? Yep. Do I like the stock at all? No. And oh, by the way, on these kind of learning stocks, I've been shorting them and making money. So, yeah, I haven't seen a stock like this, especially in the learning segment, where I've shorted them. Now they happen to be Chinese ones that I've shorted, but yeah, no. So that's kind of my little spiel. I was not thrilled, especially with all these losses here. And of course, you can actually see the pandemic hit, and boom, you know, it vaults, and then it kind of settles back down. And should it trend up? Yeah. Is it gonna? Do they have a slick website? Yep. Do people want to teach from home? No. So I don't know. It would not be something that I would just go out and buy normally. And to Ira's point, I think maybe buying some Dogecoin before Elon Musk gets on SNL tonight might be, you know, that would be kind of in the same. Maybe this would be a touch safer than that. Thank you very much.
Do I have to say that the opinions of Steve Roy are his own and don't represent better investing?
Exactly. There you go.
No. Hey, Steve. This Active Trader Pro, is that something that you need to subscribe in addition to the regular Fidelity account?
No, it's free. You just have to download it, and it runs for you.
Ah, okay. I will
Free.
try to do this. I think this is, I know you presented this couple of times before. I certainly think this is a valuable tool.
Yeah, when I start seeing these red triangles, I start getting very disappointed.
Yeah.
Yeah, and especially so close to the present time. Right, it's had 1 year of solid growth, and why? Because of pandemic, and it's very clear. Look at the volume here. The volume is, you know, you look at the normal volume, and it's what, 3 times, 4 times the normal volume, and it just went crazy. And now it's settling out. And to be honest with you, I can kind of see why you picked it, in the sense that I was shocked that Value Line had it so richly valued for next year, but it makes sense. I mean, I see it, but it's not, you know, it's yes, you can make money with this, but you have to, in my opinion, you have to time it just right.
Agreed.
Yeah, Steve, my question is, does this company aim to replace the classroom, or is it just a supplement to the classroom? Does anyone know?
Well, I would think that from seeing this now, I've just drilled down on the private schools. So people in Alaska and way out in the outer reaches of Maine and all these places where the kids aren't. This is the perfect thing to just, oh my gosh, you've got through your laptop, you've got school, and real school. Yeah, it's great. And for people who don't want to send their kids to school, this is great. But you know, at least from what I hear in the office, that they're raging for their kids to get back into class. So I just and I would imagine the 12 to 15-year-olds just got approved, or they're going to be, I think, officially, but I think they leaked it that the 12 to 15-year-olds are going to get approved to get vaccinated. So once they start vaccinating all the children, you know, I would imagine that we're not going to have hybrid sessions in the fall. We're going to have full blast regular school. So I guess, Ira, to your point, though, right, it's this component, augmentation of public schools. You know, and I don't know. Not sure. What makes sense to me with this is this piece where you actually go and buy the school. And I would imagine this would be subsidized somehow by your local district, because you're not attending school, you're attending the school online. So it could be back subsidized by your school. So I don't know how that works, but yeah. Yeah, I mean, it's pretty slick. I mean, I went into these sites, and it's, especially if you've got like an AP kind of a student at home and the high school is not challenging enough, this George Washington University looks pretty good for high school. But, you know, unless you have these special circumstances, I don't think this is going to be the mainline kind of a thing. Now, yes, it's going to do wonderful in the pandemic, and we're not out of it, but there's going to be vestiges and ups and downs in it, and where it might drive people to this. But I just don't see it, especially with all the jawing at work about it being such an inconvenience. I mean, that's all I hear. So, or not all, but quite a bit of it is that it's, it's a pain. So I don't know.
No, I mean, only thing to add, Steve, is I mean, I agree with you. Many parents want their kids to be back in the school, but still there is a segment of population that don't want to. They thrived in this working from home and learning from home environment. For them, I don't know how big that market is. For them, something like this will be beneficial. And if these guys play their cards well, that's where they're going to benefit them.
I agree, and to further that, I mean, they've really got their foot in the door now with the pandemic. People are where they would never, this would never be on their radar. They would only send them to the local schools. Now they're looking at different avenues. But even with that, I think, in my opinion anyway, people are going to want to return to just regular normalcy, and not, they want kids to interact not through a screen, but to have regular social interaction. And I just don't see it.
Yeah, no, that's
Except
fine.
in a cyclical way. Yeah, cyclically it will do well.
Yeah, no, I agree. Only thing is, if we set a goal, say within this period, this is the return we are expecting, and once we get that return, let's dump it, kind of attitude, I think would help. Again,
Yeah,
as this point,
that I can live with. Yes, that makes sense. So to me, just winging it here, like my out price would be like my high price here would be like, say, 47.7, and that would be my ultra. This is not something that I would let run whatsoever, because it's not reinventing itself. It has a system now. It just has to get it needs to build scale. So that's what it needs to do, and that's a tall order. That's a tall order for it to do. I think it's a very difficult thing.
agreed.
I had a question about sharing of the value line numbers. When you load these into the public website, do you include the value line with your stock study?
Yes, I will include.
Okay. Cynthia, I hope that will answer your question.
Okay, great discussion on that. Why don't we move on now to our individual holdings? Jack, can I have you pull up the current portfolio?
As we discussed the full portfolio, we had the early question is the club concerned with the high market valuations, specifically since it's hard to find stocks in the buy range? I need to address that with each of the stocks as they're
Sure, I'm going to mute you. There's some
Muted.
background.
Unmuted.
Joe, I only heard the first half of the question. Are we worried about high valuations for what?
I'll go back and repeat. The question
Okay.
is the club concerned with the high market valuations, specifically since it's hard to find stocks in the buy range? Maybe you would want to discuss that as you discuss each of the stocks that are in the portfolio.
Okay. Yeah, I don't see these market valuations as something to cut our winnings and run. I think this is enjoying the highs, and we'll definitely be in periods of lows here at some point in the future, just because that's the nature of investing. I think as we go through, there's some stocks that we may want to harvest some of our winnings for, but I don't think overall we liquidate everything. But having said that, I'll kick off going through our current holdings. FleetCor, the value line update came out. They are expecting FleetCor to bounce back in the next 2 years. As we all know, the pandemic hit them fairly hard in 2020. They published their quarterly results, and luckily they did surpass the analyst estimates by about 4%, which is in line with the last 4 quarters. All of the last 4 quarters have been surprises against their estimates, but it's still down 6% year over year. So I think as expected, as we've been seeing through the last year, this one was hit from the pandemic just because of reduced travel and lockdowns and quarantines and things like that. But there's still positive outlook, I guess, as things vaccine rollout and infection rate decreases and people start maybe getting out a little bit more. So I currently have this in the hold range. Its buy is up to 233. It's currently $285 per share. And then Tractor Supply, this just continues to go accelerated share price growth. It's at an all-time high for stock price. Quarterly returns beat the estimates by 50%. On the earnings call, they say sales will still increase a healthy 5 to 8% going forward. Quarterly results were helped by the stimulus checks, but also more folks are doing home-based hobbies like gardening and poultry. There was an expansion of the number of pets people had. So a lot more home-based focused effort from people, and that's really right in the Tractor Supply's wheelhouse. So this might be one, like I mentioned, that would we even consider harvesting some of the gains, but it would be a shame, I think, to sell some of it. It's well past the buy range, so I don't think we would really expand our holdings anymore. And that's what I have on those two. Steve?
Yeah. So Alphabet had blowout earnings. Revenue was up 34%. They're obliterating their 52-week high. They're making new 52-week highs. They're in my hold range. The Altman Z cranked up to 12. They were at 11 the last time I reported. Their market cap went up $55 billion. Just a juggernaut. The economy is opening up. Advertising's increasing. Google is the beneficiary. They are the giant. Visa had a good quarter. They brought in $5.7 billion of revenue, 3.2% higher than the market expected. They're also breaking through their 52-week highs, even with the pressure from Justice, which I didn't see any information on, only the initial story last month that they were going to start drilling into their debit cards, and the market just doesn't care. The stock's rolling, and we can see that their operating margins are just huge. And their Altman Z went up again. They're at 7.76. Once I did some reading, once international travel and travel starts picking up, they're going to start doing better and better and better as things get back to normal. Turning to DR Horton, it's at a 52-week high. Let me get to here we go. Yeah, I have them in, I don't know if I said this. Visa is in my sell range, though, but I wouldn't sell it. DR Horton is in, I have them in the buy range. I have them, the buy range up to 118, and the stock is currently 103. Their Altman Z went up this month also. They were 5.9 the previous month. Now they're 6.27. housing prices are currently at a 15-year high, and there's a terrible lumber shortage. The lumber mills can't supply enough lumber, and so far, from what I've been reading, the builders have been able to pass this increase in price to the consumers, but I don't know how long they're going to, because the prices are going through the roof. They're going into the stratosphere. So I don't know. But we did have a really good turn of events for D.R. Horton, kind of in a bad way. So inflation was really looking to be a problem, and that's what would stanch this with the loan rates going up. But I don't see it happening because the job numbers came out and they were so crummy last week that it looks like the inflation's going to stay down relatively. So I think D.R. Horton's going to keep rolling. And I just for last month, I had them as a buy up to 101, and they were 82 last month. So they've increased quite a bit. And again, they're at their 52-week high, or pretty close to it. That's what I've got. Thanks.
Okay, CBOE reported their first quarter earnings per share of $1.53, which beat the Zacks estimate of $1.39, but it's down 7.3% year over year. The revenue was $366 million, beat by 4.3%, and increased 2.2% year over year. The average option volume was up 19%, but the revenue per contract was down somewhat. Their guidance for 2021 is in the range of 10 to 11%. They just entered the hold range at 108. Regeneron reported first quarter of earnings $9.89, which beat the estimate of $8.79. Their earnings per share was up 50% year over year.
Well,
revenue was up 38% year over year to $2.52 billion. They missed their estimate by 2%. Now, if you look, their revenue was up 38%. If you subtract out the COVID antibody cocktail, the revenue was still up 20%. So if you think that the cocktail, is a short-term thing, we're still doing well. The Eylea and Dupixent drugs are doing very well. They're still in the buy range. I have it up to 560 as a buy. It's at 496.
okay. We got a couple of earnings reports. Essent reported 5% higher revenues, but 20% lower earnings per share. I think because of the extra reserves they had to put in that don't seem to be as necessary as they thought they were, but I guess that's still up in the air. They also announced they're going to buy back $250 million of their shares. It's about 4% of the outstanding shares. And they increased their dividend by a penny, for a penny a quarter, that's 4 cents. So went from 64 cents to 68 cents per year. Essent is in the hold zone, I think. Yeah. Dollar General is up from last month by about 10% or so. Not quite, maybe. It reports the first quarter on May 27th. it said it's partnering with the Arbor Day Foundation, and it's going to hire 20,000 workers this spring. Sprouts Farmers Market also reported their revenue was down about 3% over last year, and earnings per share was down about 10% from last year. I think last year, the first quarter last year included about a month or so of the pandemic, so that might be what's doing it. I'm uncertain. We'll have to see how they do next month, next quarter. Sprout is in the buy zone, though.
Was Dollar General in buy?
Dollar General was a hold, sorry.
Okay.
Okay, that's it for me.
Thanks, Jack. Liz?
Okay, so we have Ulta. They had a new value line report and says that the shares are currently pegged to outperform the broader market in the year ahead. The projections also reflect a decent growth opportunity over the 18-month time frame and slightly above average price appreciation potential out to 2024, 2026. Value Line downgraded the price stability to 35, downgraded the earnings predictability to 45, downgraded the technical to 3, and upgraded the timeliness rank to 2. And they are currently in the hold zone, and they are sneaking up to the sell zone. So I have it as a hold up to 328, and they're at 322.74. So 328.7 is when they get into the sell zone. So that's Ulta. FSFG. They are in the buy zone still, and buy zone is up to 99.8, and they closed at 69.10. They reported a net income of $10.5 million or $4.39 per diluted share for the quarter ended in March, compared to a net loss of the same time last year. So they're doing better. Value Line downgraded them on performance in March, upgraded them on financial strength to a C++ on April 30th. And the EPS is up since the last quarter. It was 4.16 at the end of 2020, and then it's 4.39 as of the end of March of this year. So that's FSFG. They're in the buy. And Middleby, the big news with Middleby is that they have they've acquired Well-Built in a all-stock transaction. So Well-Built says it provides the world's top chefs, premier chain operators, and growing independents with industry-leading equipment and solutions. And so this Well-Built, they're calling it an acquisition, and it looks like it could be more like a merger sort of thing, because their boards, some of the Well-Built board people are going to be moving on to Middleby. Let's see. The Well-Built shareholders are going to receive a fixed rate of exchange of Middleby, and each share of Well-Built is it's going to be an all-stock transaction. So Middleby shareholders are going to own about 76% of Well-Built. and well-built will own about 24%. So that's that. Let's see here. So they are inching up into the sell zone as well, but they are still in the buy. I mean, I'm sorry, they're still in the hold zone. So they closed at 182 and 83 cents on Friday, and the hold zone is up to $187.40. So they're getting up there into their sell zone. Value Line downgraded their technical rank, downgraded their earnings predictability, and upgraded the price growth persistence to 60. That was just at the end of April. So that is it for Middlebury. So that's it for me. Sriram?
Hello again. After we sold Miller, I have only INS, the Intelligent Systems Corp. So far, so good. Nothing surprising, nothing unexpected about this. Actually, the Value Line, they have a, I believe, April 30th report on this, and they, in fact, they upgraded across the board on several areas, so which I thought is a pretty good sign. Again, the progress they're making seems to be in the right direction. I do not have anything more specific to talk about this. Only thing I certainly want to ask you all is about looking at the PERT analysis and look at this in a overall way. I think Brent, one of the recommendations I make is maybe we can put the PERT analysis before individual reports on our stocks we are watching.
I was after we wrapped up the discussion on status of individual stocks, I was going to ask if we wanted to go over the PERT this meeting before we made any buy or sell recommendations.
Okay, no, what I was recommending is the PERT analysis. Probably it makes sense if we do it before we do our individual presentations. Maybe we can do it next month. Consider that.
Well, I mean, do you have it ready to go over today?
Yes.
Okay. Why don't we, if there's no other comments, I did want to mention, Sriram, that I assigned you the Superior Group of Companies, SGC. So next month, if you can add that to your tracking list.
Okay.
That's what I think we bought that last month.
Yes.
But I'll make you presenter if you want to bring up the PERT report and we can walk through it pretty quick.
Yes. I mean, again, for the most part, our portfolio looks, oh no, why do I have I'm sorry, bear with me, I think I have the wrong report. Just have it. This is better. Okay. No, it still did not update the prices. Huh. Yeah, Brent, let's skip this. I will sort this out for next month. But in the big picture, I do not see anything that is of concern at this point. looking at the PERT.
Okay.
I don't know why it's not updating the prices. I just updated them per input. If any of you have any updated information on any of your watch list, please, not watch list, the stocks you are keeping track list, please send me. I will update that. But Brent, going back to what I was trying to say is, from next month onwards, if it's okay with you, we will go over this before we go individual reports.
Okay, just out of curiosity, why that suggestion?
That way we can compare the individual reports to what the PERT is telling us.
The individual status reports from the people tracking them?
Yes.
Okay. All right, we'll table PERT for until next month
Yeah.
then.
Hey, Joe, I know you are the PERT expert. Do you have any recommendation on that, when to do this?
Say that again, Ron.
Do you have any recommendation, Joe, on when to do the PERT analysis, before or after individual reports?
I like to have them kind of stuck together so that as the individual reports are given, you have the PERT available on screen for part of your discussion. That's just a personal opinion. That's what I try to do.
Okay.
Yeah, we could. The one advantage I like of having the Vivio, holdings on the screen is that we see how much of the portfolio it's each individual security contributes, and I'm not seeing something like that on here, but maybe I'm just missing it. We have total return. I don't know if there's percent of portfolio on here somewhere. But I agree, we could post this in place of that, or maybe do a split screen or something.
Right.
So as we're doing individual reports, we'll have this for reference. Okay. Well,
Okay.
we'll look forward to going over this next month then. So then we'll open up the floor to any buy or sell proposals.
So I have SGC as a buy still. I don't know what you guys have.
I'll look real quick.
I had FSG as a buy.
Yeah.
Yeah, CGC is still in the buy for me. I marked down, I think we mentioned a total of 4 companies that people said were in the buy range: Regeneron, Sprouts, FSFG, and now SGC. And I think SGC is our lowest holding at around, what, 3% or so?
Yeah, I think
Jack,
DHI too.
Give you back presenter rights, Jack.
Okay.
DR Horton was in the buy range?
I think so. Is that right, Steve?
Yes, it was. It was DR Horton was in the buy range. Yes.
Oh, okay. I might have not written that down because the 8% of our portfolio is, I figured we had enough of that, but okay.
Agreed. Yeah. And plus, the market's super frothy right now. So.
Right. Well, I'll make the boring proposal of we put our current cash into SGC. That'll only move the needle. It'll bring it up, what, to like maybe 3.5% or something.
3.6%.
Yeah.
Yep. I like that.
Yeah, I could go with that.
I agree.
I think we should I recommend we put Learn on the watch list.
Okay.
And follow how it's doing.
Okay. Steve, any opinion on the SGC? And
Yeah, I second both those notions by putting money into Superior Group to raise it from the 3%, and then also taking a look at Stride LRN. See how, because it might do well in the coming year.
right. Okay. Well, it sounds like unanimous. Then buy SGC. I'll add LRN to the watch list. Anything else? Okay. I think that's one of our shortest shortest buy sell sessions ever.
Yeah.
That's great.
Nice.
Yeah. Okay. Let me. I'll take back presenter rights here.
Good point. I have a question for Steve about his fidelity chart that he had up earlier, and some of the verticals were red and some were green, despite the triangles having opposite colors. And Leslie asked, can we explain that?
Yeah. So what that means is the green triangles pointing upward means that the previous year's same quarter. Oops. Okay.
If you want to share your screen, Steve.
Bigger.
There you go.
Yeah. Can you see it now?
Yep.
Okay. So what this means is, let's take, say, this one here. So this was in August of 2020 when their earnings started to go up. And we're just going to look at the triangles for right now. If we look at the previous year's August, so it was 8 cents. And here it's 12 cents. So a year over year, it's 4 cents. Hang on just for a minute. I'm sorry. Just. Sorry about that. Okay. So, and then the red triangles pointing down mean that, let's take, so this is April of 2020. And if we look at the previous month of that, so here it made 44 cents a share for the April quarter. And here it made 22, half, right? So you had a fluctuation. So that's why this triangle right here is red. So then the other question was, well, how can you have a green, if I got the question right, how can you have a green triangle with a red line? What does that mean? So if you notice, I can't really zoom in. Yeah, let's see. I don't really zoom in that much, but let's see here. When we came in to this month, it was actually higher than when we exited. When we came into the quarter, we actually came in at a value higher than when we exited the quarter. That's why this line is red. Even though it shot to the moon during the quarter, it was very volatile. It actually ended the quarter lower than when it began.
So
and
it's
so
a price bar.
The red line, right? We're just talking about the red line now.
Yes, sir.
So
Okay.
Here you can see it again. You come into the quarter higher and you exit the quarter lower. That equals a red line. And if you come into the quarter lower and exit the quarter higher, it equals a green line. That's how that runs. So I hope that answered the question.
Okay. Yes. Thanks, Steve. I'll jump back to our agenda. The only old business I have was the PERT. We mentioned we'll talk about that next month. Our upcoming assignments, June, I have Ira as stock to study and Jack for the educational segment.
Yep. Yep.
Okay.
Yes.
And then July, we still have Sharon Watkins penciled in. If she's with us today, I haven't heard anything from you, Sharon, so let me know by email if you're still interested in that slot. Otherwise, we'll do some rearranging again.
I don't see her name on the list today.
Okay, I'll reach out to her separately then. Okay. And then here's the next 4 meetings. Like always, it's second Saturday of each month, 11 a.m. Eastern. Any other old business, new business we need to discuss? Any questions or comments, Joe, we should go over?
I think we've been covering them as we've gone along. Oh, yeah. We got them all taken care of, I hope.
Perfect.
I at least made the attempt.
Okay. Thank you for the effort. And certainly, if any questions come up after we end the session, feel free to reach out to Sriram. So thank you, everyone, for attending our May meeting. Like I mentioned, our next meeting's in month time, second Saturday, June 12th, 11 a.m. Eastern. This recording, as well as our previous meetings, are on YouTube, so you can search for Yankee Model Investment Club. They should be all available there. Like I mentioned at the beginning of the meeting, if you are forwarded an invitation to attend, make sure that we have your contact information so that we can remind you automatically of upcoming meetings. So you can go to Better Investing and register there. And also wanted to put a comment about the Better Investing Visit a Club program. We talked a little bit about it last month, but would encourage people that are in their own investment clubs, to look into this program and possibly sign up. It's a way to encourage individuals that are interested in investment clubs to come and see real working investment clubs, as well as be a potential source for new members. So you can get more information on betterinvesting.org to search for Visit a Club. And then there again, Sriram's contact information if you have questions or if you're interested in joining us as a member. And with that, we'll close the meeting. Hope to see you again in June, and have a great rest of the May. Thanks, everyone.
Thanks, Brent.
Thank you,
All
everyone.
right, bye.
Thank you, Brent.
Bye-bye.
Thank you. Bye-bye.
Thanks. Bye.